So now let's talk about how no commission annuities can solve some of the interest rate risk and low yield problems that we saw on the previous slides, right? So what a lot of financial advisors don't realize is that annuities are just investments in long-term bonds without interest rate risk, and by stripping out the commission part of these annuities, it allows the advisors to do two things: provide higher yields for their clients' bond portfolios, as well as the ability for the advisor to charge their RIA AUM fee pre-tax, just like they are on clients' retirement accounts. Again, so let's summarize the benefits of no commission annuities and how they can solve some of the problems of low yields in this environment, and a limited ability of high net worth clients to contribute to retirement plans. So again, we have bonds in our taxable portfolio, bonds in a retirement plan, and bonds in no commission annuity. So let's look at how no bonds through it in a no commission annuity can solve this problem, right? So can you defer taxes? Again, bonds in a taxable portfolio, you cannot defer taxes, whereas bonds in retirement plans or bonds in a no commission annuity, yes, you can defer the taxes here. Can you charge your AUM fee pre-tax? Not if those bonds are in a taxable account, but you can if those bonds are in retirement plans or in the no commission annuity. Can you dump in a large amount of assets all at once into either of these vehicles? Well, you can if it's in a taxable portfolio, right? There's unlimited amounts that you can kind of invest in taxable bonds. Obviously, we talked about how the retirement plan has contribution limits, so you can't do an immediate dump in, right? You have to try to find backdoor strategies here. Bonds in no commission annuity, you can dump in a large amount of assets, right? So you can dump millions of dollars here through no commission annuities. So for clients who can't figure out how to get their bonds into tax preferred vehicles, this is a great way of doing it, right? The other issue that bonds in a no commission annuity solve that bonds in a retirement plan can't solve, and neither can bonds in a taxable portfolio, is this interest rate risk, credit risk problem we were talking about, where no commission annuities allow clients the ability to invest in higher yielding long-term bonds without the interest rate risk. So no commission annuity solves the contribution limit problem of high net worth clients, as well as the interest rate / credit risk problem of retirement plans. So again, let's summarize what a no commission annuity is. All a no commission annuity is an investment in long-term bonds without interest rate risk that receives the same tax benefits of a retirement plan, except with the additional ability to contribute millions of dollars into it, whereas retirement plans have more hard contribution limits. There are no expense loads in the no commission annuity, which allows for higher gross returns for the client, and as we'll see in a second, higher after-tax returns as well. So this vehicle is really built for RIAs to earn their AUM fee pre-tax instead of charging it on an after-tax basis in a taxable account, which, as we talked about, reduces tax liability for clients and provides clients with higher after-tax returns. So RIAs can use no commission annuities as financial planning tools to more effectively help clients achieve their retirement goals through higher after-tax yields, while also providing them with additional protection against interest rate risk, which is very important in a low yield environment. So let's look at the two main types of annuities that invest in long-term bonds, which are fixed annuities and indexed annuities. There are also no commission variable annuities, but those invest in equities, which obviously we're leaving out of the conversation here. So fixed annuities, right, are investment in long-term bonds without interest rate risk. So the trade-off here is that you're exchanging part of the yield of the long-term bond for no interest rate risk. So you could invest in long-term bonds, or the client could invest in long-term bonds directly through a taxable account or in a retirement plan, but they would get no protection of interest rate risk, right? So they would get higher yields than they would through the fixed annuity, but they'd be taking the full interest rate risk, such that when interest rates rise, clients would be absorbed with a loss. So in order for a protection against that loss, they're accepting a lower yield of the fixed annuity, right? But again, the fixed annuity will be higher than intermediate bond indexes like the AG, right? So it's a great way to provide stable fixed income and, like we talked about, greater after-tax returns on bonds, right? So for clients who want more yield, right, than just a straight long-term bonds, the ability is there for them to invest in what's called an indexed annuity, which is still primarily a long-term bond investment without the interest rate risk, but it's also a part apart investment in an index that provides a floor against losses and a cap on the gains. So what this does is it provides them with additional yield, right? So similar to the fixed annuity, you're exchanging part of the yield of long-term bonds for no interest rate risk. But the benefit that comes here is that you have the ability to participate in equity markets that have a higher gross return, right? So it's protecting them against losses. So if that equity index, absorbs a loss, a negative 10% or 20% in a given year, it's providing them protection. So the client absorbs no loss. In exchange for not absorbing a loss, when the index does really well, there's a cap on the gains. So this structure here allows for the same protection you get in the fixed annuity, but with the ability to participate in an equity index that is making higher returns. So again, the returns on an indexed annuity will be higher than a fixed annuity, but will obviously be more volatile because the fixed is just a straight yield that they're providing. However, you'll find that indexed annuities in a low yield environment will be less volatile than the underlying bonds, right? Because there's no interest rate risk. So if the choice is between risk and return, you can choose here. Is that the fixed annuity will be lower return, but also less volatility. The indexed annuity will have higher returns than the fixed annuity, but be more volatile than the fixed annuity. But again, either comparable volatility with the underlying bonds or less volatility. So let's look again at the historical returns of both bonds and no commission annuities. So here we have two standard bond indices, the AG, which is an intermediate term bond, and the IGLB, which is a long-term bond index. So we can also see the returns, the compound annual pre-tax returns from 2016 to 2019, as well as their annual volatility. So the AG from 2016 to 2019 returned about 3.5% compounded during these years. The volatility on that same index was about 3.28%. The IGLB, on the other hand, was about 7.62%, the compound annual return. So significantly higher, but also it's a long-term bond, right? So as we talked about, it has higher yields than the intermediate term bond. But the volatility is also higher, right? So the volatility of the IGLB over that same period was about 8.18%. Well, how do these two indices compare to no commission annuities, no commission fixed and indexed annuities, right? So let's look at that. So the no commission fixed annuity over this period, and this is just from one company, but gives you an example of how fixed annuities and indexed annuities compare to the underlying bonds. So the no commission fixed annuity was 3.30%, so a little less than the AG, and significantly less than the long-term bond yield. But again, part of this bond yield was from interest rates declining, right? So capital appreciation. So the no commission fixed annuity, again, was a little bit less, but the volatility, extremely low volatility, because they're essentially giving you a fixed rate of return, right? So lower yield than the long-term bond. In this case, it was lower yield than the AG, but again, significantly lower volatility. The indexed annuity, however, did really well. And we can see the reason why it did well is because, again, you had a very good bull run during this period on an equity index. And this was just the index, the S&P 500. You can choose different indices within a no commission annuity. But the indexed annuity had significantly higher returns, whereas it had similar volatility to the AG, right? So the indexed annuity provided higher returns and similar volatility. So that's why these fixed and indexed annuities can provide great bond vehicles for the bond part of your investment. So again, most RIAs would not invest a large portion of a client's bond funds into a long-term bond fund as they're nearing retirement, because they don't want the interest rate risk. They don't want this volatility. But the indexed annuity allows the client to see reduced volatility compared to the long-term bond funds, while also achieving higher returns than the shorter term AG. And again, keep in mind, like we talked about, the higher yields here of the long-term bond really came from capital appreciation. As interest rates were declining, long-term bond capital appreciation was going up, right? So that's where the additional yield came from. Obviously, we're in a low-yield environment, right? Historically low. So interest rates will be going the opposite direction, in which case you'll absorb losses. So again, a little bit different historical context versus going forward, but it does allow us to compare, and we can see that the volatility of the long-term bond funds versus the shorter ag, as well as the volatility of the fixed annuity versus the indexed annuity and the returns. So this is why you can use these vehicles, the fixed annuity and the indexed annuity, as a way to invest in bonds with either. You're going to get either higher returns with the indexed annuity, or you're going to get reduced volatility. So depending on what the client needs, their risk profile, and how this fits into their modeling, you can figure out how to best invest in bonds by using these vehicles. And again, this is just the gross yield. This isn't even accounting for the tax benefits, right? That we mentioned earlier. So again, no commission annuities offer either higher yields or lower volatility than current bond allocations, if used properly. So let's look at current yields in today's environment. We can see that as of September 7th, 2020, the current pre-tax yield to maturity is about 1.13%. That's an effective duration of 7.92. So in other words, if interest rates rise by 1%, this ag will absorb a 7.92% loss. On the IGLB, again, the returns are higher, right? But again, look at the interest rate risk, the duration. So if yields rise by 1%, clients will lose about 14% if they're invested in this IGLB. And that's why, again, RIAs will typically avoid it as clients are nearing retirement. The current fixed annuity and indexed annuity, again, from the same company here, you can see that the fixed annuity is obviously less than the long-term bond, which is what we'd expect, the yield to maturity, pre-tax yield. But it is significantly higher than the ag, right? The significantly higher benefit here that is being provided. The duration we can't obviously measure because we can't see how it's being affected, especially since the volatility is lower. And the no-commission indexed annuity, again, if you simulate it, right, again, you get a floor and you get a cap. And if you simulate those results in your Monte Carlo, you'll see that the gross yields are about 3.8%. So you're actually achieving a higher yield than the long-term bond index, which without as much volatility as we showed previously. So again, just to summarize, the no-commission annuities can offer either higher yields or lower volatility than current bond allocations, right? And so just this is, as you're creating kind of scenarios or portfolio allocations for your clients, this is how you can use these tools to provide either higher yields or lower volatility. So I actually did this analysis, right, with Monte Carlo simulations. I compared a no-commission indexed annuity with just investing in long-term bonds in a taxable account, and in this solution we found that by doing the Monte Carlo results, and you can again do this in your own models if it's flexible enough to do so, the no commission indexed annuity outperformed the underlying long-term bond index on an after-tax, after advisory fee basis in 83% of the scenarios, right? So you can read that white paper, which is called Investing in Long-Term Bonds Without Interest Rate Risk, the no commission annuity solution to improving after-tax, after advisory fee bond returns. That's provided on Colva's website. You can research that and essentially see how we did that and the benefits, again, of using no commission annuities in general for clients' bond allocations. So now let's go ahead and talk about how can using no commission annuities actually help to increase AUM for RIAs through the acquisition of untapped markets. And this is a whole area that RIAs really aren't considering. And the fact is that clients and investors are increasingly wanting these products. They want fixed and indexed annuity sales because investors who are worried about market corrections and low bond yields are turning to fixed and indexed annuities. From 2012 through 2019, we saw a huge uptick in the amount of fixed and indexed annuity sales. In 2019, in fact, $200 billion in annuities and another $140 billion in life insurance was sold. And most of these were by high commissioned agents. So what does this mean? If these products are being sold by high commissioned agents, that means the expenses in these products are really high and they're not always in the best interest of the clients. So there's a huge opportunity for RIAs to realize, like, look, clients actually want these products and they can deliver, tax deferred gains or tax free gains in the case of life insurance. And if RIAs really understood how to use these products as financial planning tools and understanding that bad products are sold because of the commission and nature and the conflict of interest, but at its core, these products can be used as financial planning tools. RIAs could capture a huge segment of this market because most of this $200 billion in fixed and indexed annuity sales in 2019 were the high commission ones. Most of the $140 billion in life insurance being sold are the high commissioned ones. So if RIAs started to use the no commission version and then again charging their fee on the assets instead of an upfront commission, they're essentially getting a trail, right? The same way they're doing with their business model is you build up a huge base and you charge a fee on it. This is a great opportunity for RIAs to increase their business, to penetrate this channel, capture market share, and essentially, utilize more sophisticated financial planning tools in order to grow their existing business. The issue is that a lot of RIAs are not comfortable with insurance, right? A lot of these products have historically been not in the best interest of clients, and many clients have had bad experiences, and probably almost every RIA has had a client who's been sold a bad product and then been tasked with the job of trying to get them out of it. But the industry is shifting, and this is a great opportunity for RIAs to understand, look, in this low yield environment, insurance products, particularly the no commission ones, can provide better yields simply because of the structure.